All right, good morning, everybody. It's Tuesday morning, Tuesday, May 7th. Happy May. This is our first webinar in May. Good to see everybody. So we're going to talk about quite a few things today, and we've got some headlines that we have to go through. And today is a big topic, of course, because we're talking about proposed changes to Roth conversions. Roth conversions is one of the best and most frequent tools that we use to help people shift from what my friend and mentor Ed Slott says, from forever taxed to never taxed. Previously, there were some income limitations on Roth conversion, but they don't exist now. But we're going to talk about some proposed changes that came from the Biden administration regarding tax law updates, tax code updates, and in that those proposed changes is back to income restrictions for Roth conversions. So that could affect a lot of folks, and including clients of ours. So it's important. We're gonna go through a lot of or several parts of that report, but today we're going to focus on changes to or potential changes to Roth conversions. I want to remind you of the goals for this webinar for you and any education course that I have. But I want you to be inspired to make changes away from the things that you've maybe learned for the 20, 30, maybe 40 years that you've been investing, saving, planning, because it's likely that there are critical items that maybe you were not made aware of, or maybe you were steered in a incorrect direction, and we want to correct that course for you. But I want you to be inspired to make those changes. I want you to open your mind to different ideas and ways of thinking about planning and investing. I want you to stay educated. These webinars are about education, not advice. You should not be taking financial advice from anybody on YouTube, including myself, because the advice is very specific and individual. But education is very good, because then you can figure out what advice and what path works best for you. And I want you to always stay updated. And you have to stay updated because of things like this. So we have proposed changes in the tax code, and some of them may be enacted, some of them may not be enacted, but we have to stay on top of them and understand what's going on, and how do we plan without knowing what's ahead of us. You know, one of the things that I love on my the GPS, and everybody does it now, is if there's traffic up ahead or an accident up ahead, your GPS reroutes you. And it gives you at least the opportunity to be rerouted, and it tells you the estimated period of time that it's going to add if you stay in your course, or it's going to save you or change if you take a different course. Financial planning is very, very much the same, but you can't make those changes without that information. It used to be that you'd drive to the airport and you either hit traffic or you didn't hit traffic, and you didn't know until you were right up on it. Well, now we have the tools available to us to see way ahead in that traffic. And it's really the same with financial planning. And we have to stay updated, stay educated, stay open to make those changes. And it's very, very important. So I appreciate you being here, and I hope that they're my goals for you for these webinars. So I hope we achieve those together. So we're going to talk about some headlines first. And I told you our Financial 15 section of today's webinar, we do 15 minutes or so of information updates from the Ed Slott Group, and that has to do with IRA distributions and RMD rules, anything really around retirement plans and IRAs. And if you're just joining us for the first time, please be sure to hit that like, subscribe, and notification buttons. It's just so you're notified when new videos come out. And we typically have 2 or 3 new videos a week. And they're either a special announcement or some version of this webinar here. We record the whole webinar for you and release that out to our email list and post it on YouTube. And then we also break out the Financial 15, and sometimes that goes into just 1, sometimes 2, sometimes 3 videos. So today we're going to be talking about the general explanation of the administration's fiscal year 2025 revenue proposal. So we can call this the President Biden's proposals for revenue, which is tax. So these are proposed changes to the tax code. And today we're going to focus on a subsection of that 256-page report, and which is modifying rules relating to retirement plans, and then a subsection of that, which is elimination of Roth conversions for high income earners. So we're going to discuss that in today's video, but we have some upcoming things we're going to discuss from that report also, including increase in capital gains tax rate, elimination of the backdoor Roth contribution. So there are some really important planning tools that are affected by this proposal, and we need to pay attention to them. Other headlines. So this morning, or I don't know if it came out this morning or late yesterday, but we received the 2024 Trustees Report for Medicare and Social Security. So what does this Trustees Report tells us? It tells us the financial stability or instability of these programs, Social Security and Medicare and Medicaid. But the focus is in this report, and what I'm going to share with you today is when these trust funds are scheduled to run out. So there are trust funds for each one of these programs, Medicare and Social Security, and those funds are scheduled to be depleted. This should be no new information for anyone listening on this webinar, because this has been talked about really for decades. There's just adjustments every year, and every year this group of trustees are required to report to us, and this is a legislated group of individuals, and they produce this trustees report. And it's no secret. You can find it on the even if you just Google which is exactly what I did this morning when I started reading some news releases about this, I Googled 2024 Social Security and Medicare Trustees Report, and it comes right up. And you can go. It'll direct you to the administration, the Social Security Administration, where the report is, and you can just review the summary. The summary is long enough. The total report is, I couldn't even tell you how many pages because I haven't looked at the total report yet, just the summary. But the story is that Social Security is still scheduled to completely be depleted, the trust fund be depleted by 2033. So that hasn't changed. That last year it was reported to be 2033, and this year that's the same. That would result in a 21% cut in benefits. So if the trust fund is depleted and nothing is done to shore that up, then there would be a 21% cut in Social Security benefits. Now, Medicare got a bit of an extension. Medicare now, I think it was pushed out 5 years, is now 2036. Now, don't think for a minute that means we're spending less on Medicare or that there have been any changes to how we fund Medicare. It has to do with, first of all, the economy is better than we thought it was going to be, or the trustees thought it was going to be from the last report. So we had more payroll tax paid into Medicare. That helps. And then they also made some changes again to how they record veterans benefits that made some adjustments to the proposed time that the trust fund is depleted. So if Medicare trust fund depletes, and we're going to spend a whole webinar discussion about this, I'm kind of giving you highlights. If the trust fund for Medicare is depleted in 2036, or when it's depleted, whenever that happens, you'll see 11% shortfall, which means there'll be an 11% cut in benefits, which is, again, significant. And no one will accept these cuts. No one will accept a cut in their Social Security. No one will accept a cut in their Medicare benefits. So something's going to have to be done between now and then. And Medicare and Social Security certainly are two of the three reasons, and the third being interest on the national debt as the debt continues to grow, nearly $35 trillion today. But Medicare, Social Security, and interest on the national debt, and you can see the dates here. Again, 2033 for the depletion of the trustee or the trust for Social Security, and 2036 for the depletion of the trust for Medicare. That's two of the three reasons we believe that taxes are going to have to increase dramatically, probably by about 2030 or so. We may be edging out to 2033, 2034 at this point, which is good from a planning perspective for us. It gives us more time to do the things that we need to do for you folks and for our clients to shift your forever taxed holdings to never taxed again holdings. But we'll talk a lot more about this in the coming weeks. We have a lot to talk about. I have things. I have more. I'm looking at the report, the general explanations report that I talked to you about earlier, but I'm looking at that sitting here on my table. Today we're going to talk about proposed changes to Roth conversions, but there are a few other items that I just have to share with you. And now we're handed this Social Security and Medicare trustees report, so that's going to add a few material for a few weeks going forward as well. So we've got a lot to talk about together over the next few weeks. Okay, let's go into our Slott Report. So again, I'm going to share this great information I get handed to me every week by the Ed Slott Group, and I like to share it with you. I get really wonderful feedback from you folks when I put these things up on the screen, and I just share this with you. And my goal, again, is not that you become experts, but I want you to pay attention, and you know that this we're going to read right now about your RMD is not eligible for rollover. You folks are astute now. You've been paying attention to these webinars. Some of you for years. You attend every week. I see you live here, or I see that you watch the recording, or you give me feedback. And you know, I didn't say. Let me just drop a chat in here real quick. I'm just going to say good morning, and if you can let me know you're out there, I'd really appreciate it. But you know, several of you folks listen to this live, and many more listen to recordings. And again, I don't want you to be expert. You've got things you want to do, but there may be something that just reminds you that, hey, you know what? I've got these RMDs coming up, and you might think I can roll that into a Roth IRA or another IRA. Well, the law, the tax code doesn't allow you to do that, and you folks know that now. But we still have people, or maybe you're just learning this, but we still have people all the time who are asking these questions, and it's important to help educate those folks. Or maybe you have a neighbor who says, geez, I have this RMD, and I'm just going to take it and put it to my Roth IRA. And you might say, no, I don't think you can do that. You might want to pay attention to this, or contact Mark and his team, and they can walk you through that. That's really, really important when you can help other people. Good morning, everybody. It's good to see you. Thank you for saying hello. All right, so let's read this together. This is from my friend Sarah. Sarah writes, your RMD is not eligible for rollover. If you are at retirement age, you might be at a high risk for excess contributions due to rollover mistakes. This is because of the rule that says that the required minimum distribution, that's an RMD for the year, cannot be rolled over. In fact, the RMD for the IRA must be taken before any of the funds in the IRA are eligible for rollover. For example, an RMD must be taken before doing a Roth IRA conversion. This is probably common mistake number one that we see for folks who are in the RMD age, and they're now embarking on Roth conversions. Maybe for the first time, they forget that they cannot do a Roth conversion prior to doing their RMD. They think that, well, hey, I'm going to do my Roth conversion now, May 7th, because for whatever reason, but I'm going to wait until December 31st to take my RMD. Not so fast. That won't work well. But we're going to talk more about that. Now, on to the second paragraph. If you mistakenly roll over an RMD, you will end up with an excess contribution. Very often, many people think they can fix the problem by simply taking a distribution from the IRA that received a failed rollover. Not so fast. Sarah says, it's not that easy. The RMD was distributed. That part went fine. However, because the RMD should not have been rolled over, it's considered an excess contribution and must be fixed as an excess contribution. We talked about excess contributions a few weeks ago. Sometimes the failed rollover is not due to a mistake on your part. Sometimes the mistake may be the fault of the plan administrator handling a rollover from a company plan to your IRA. If the ineligible dollars are included in the amount rolled over to the IRA, an excess contribution in the IRA is the result. Roth IRA conversions are considered rollovers. If you mistakenly include your RMD in a conversion instead of taking it first, you'll end up with an excess contribution in your Roth IRA. Folks, Sarah touches on maybe the plan administrator made a mistake, distributed the funds prior to the RMD. You have to be really, really careful with these call centers and the people you're talking to on the call centers. I mean this as no disrespect to the hardworking people out there, but I will share with you that Friday morning I was on a conference call with a client and one of our team and someone from an insurance company asking a very, very important question about this person's investment with this insurance company. and we got conflicting information in the same sentence. So they told us two different answers in the exact same sentence, and then decided, okay, I am certain actually that this is the right answer. Well, I walked away from that, and we hung up the phone with that representative, and I just shared with my client and with the other member of the team that I had zero confidence in what we were just told, and we had to go back and start the process over again, get some things in writing. Folks, we learn about incorrect information all the time that comes out of these call centers. So, while it's important to share this information with those call center people so that they can be trained up, I stressed to this person we were talking to, I said, this is a forever decision. This client is in her 80s. She has to make an important decision based for her investment with this insurance company, and it's a forever decision for her that cannot be changed. And we needed the correct information, and this person had no clue what they were talking about. Also, I said, no disrespect, but could you get me the person you're going to that asked these questions? Because we were put on hold and brought back. Obviously, the person was asking questions and told us he was asking questions. But he said, this person's not available. No one's available other than me. In fact, you can't. I said, well, can I speak to a supervisor or someone like that? No offense to you. I don't want, I don't need a learning curve on my client's forever decision. But I didn't say that to that person. I'm saying it to you. But there was nobody that person could transfer me to. So now we were just in a situation where we're hanging up the phone and calling back and hoping that we get someone more seasoned. So we spent a significant amount of time getting the correct information. And I'll just share with you that person was completely wrong, by the way. So be careful where you're getting your information from. So let's go back to correcting an RMD. So we are here. Correcting an RMD, that becomes an excess contribution. If you have mistakenly rolled over your RMD, do not panic. This is a mistake that can be fixed without penalty if you act in a timely manner. And we have some good amount of time for this if you pick up on it right away. If you correct the excess contribution by removing it, plus net income attributable, any growth you have, by October 15th in the year following the year of the contribution, you can avoid the 6% excess contribution penalty. Yes, it's true that some people make this mistake year after year after year, and then it's a lot of unwinding, but hopefully you're reviewing your plan every year. You're talking to your certified financial planner every year. You're working with your CPA every year, and these mistakes are caught really, really quickly. So here's the example. Carla, age 75, has not taken her 2024 RMD of $9,000. She rolls over her entire IRA balance to a Let me start that over again. So here's an example. Carla, age 75, has not taken her 2024 RMD of $9,000. She rolls over her entire IRA balance to a new IRA. Carla's RMD of $9,000 is considered an excess contribution in the receiving IRA. The problem cannot be fixed by Carla simply taking a distribution of $9,000 from the new IRA. She will have to correct the excess contribution. If Carla removes the $9,000 plus the net income attributable as a corrective withdrawal by October 15th of 2025, she will avoid the 6% penalty that applies to excess contributions. So I hope that makes sense. Net income attributable is simply any growth you have since that contribution was made. So let's talk about rollovers and success for beneficiary rules as part of today's Slott Report mailbag. So the mailbag, again, is when people write into the Slott group and then they write really, really great answers back to these individuals. And this is from our friend Andy Ives. The first question is, my client is terminating employment and rolling over the funds from his 401k. He was told that the funds must be rolled over to a rollover, air quotes if you're just listening, rollover IRA, and kept separate from any other IRA funds that he has. He already has another IRA, and he just wants to roll over the funds to the IRA. Is that allowed? Thanks, Jim. Well, Jim, this is another example of call center individuals not having all the facts. There is absolutely no difference between a rollover IRA and any other type of IRA, traditional. These we see it even with custodians that we use. We see contributory IRA, rollover IRA. It's the same thing. You can keep your IRAs separate if you'd like for your own accounting purposes, but we certainly segment IRAs. If you're clients of ours, you know that we have a sophisticated segmentation strategy. But as far as what the tax code says, there's no reason you can't combine them. So the answer is yes, your client is allowed to roll his 401k into his existing IRA. There is no downside to commingling former 401k dollars with IRA dollars. The question, I inherited an IRA from my brother. I have named my wife as the beneficiary of this IRA. Can she do a spousal rollover to her own IRA after my death? The answer is no. A spousal rollover is not an option. If your wife were to inherit this inherited IRA from you, that would make her a successor beneficiary. As a successor, she must follow the applicable rules established by the Secure Act for deaths after 2019. Regardless of who the successor beneficiary is, the 10-year rule will apply, and the successor will continue with the same required minimum distributions, RMD schedule, as the original beneficiary in years 1 through 9. The account must be emptied by the end of the 10th year. For situations where the 10-year rule had already begun with the first beneficiary, the successor can only continue whatever time remains on the original 10-year period. Confusing, I know. The rules are confusing. Hopefully we get some clear and final guidance from the IRS this year. But that is our slot section today. So moving on, we're going to talk about the markets briefly. Let's first talk about what happened in the markets last week, and then we'll talk a little bit about what the analysts are saying. So the Dow Jones, a great week last week. We all know that it was nice to see some recovery. We've been working a lot. We've got, because of our segmentation approach, and if you don't know what I'm talking about with account segmentation, you can write to us at questions@attleborowealth.com. That's questions@attleborowealth.com, or you can find a video on our website at attleborowealth.com or on YouTube called The 3 Pillars of Investing that I did some time ago. It's funny when you look at these old videos, you think they're really great and wonderful when they first come out, and then you look at them later and you say, boy, I have to reshoot that. But it's still out there and it still works. The facts are still good. So that's attleborowealth.com. And again, if you're saying, what the heck are you talking about with account segmentation, Mark, you can write to us at questions@attleborowealth.com. But we saw some really nice growth in the markets last week. Even the dreaded bond market. But we've been doing a lot of work behind the scenes in our investment committee about with protecting the early part of our segments 1, 2, and 3 from even more so from volatility. So rest assured, if you're clients of ours, you've already seen adjustments. There are some folks that we want to talk to before we make those adjustments, but we've got some really exciting changes that we're making. So we'll have that conversation soon, I'm sure, if we haven't already. So the Dow Jones Industrial Average last week was up 1.14%, giving us a 3.21% year-to-date return so far this year, and still from this time last year. So this is for the week ending May 3rd, Friday, May 3rd, but as of May 3rd, 2023 to May 3rd, 2024, the Dow Jones Industrial Average is still up 18.20%. The S&P 500 was up just over 0.5% last week, bringing us for a year-to-date of just under 8% for the year. The NASDAQ was up 1.44%, bringing us a year-to-date return of 7.86%. The global indices were up as well. So we have the MSCI World Index that it does not include the U.S., that was up 1.46% for a 4.45% return for the year. The emerging markets index was up 2%, still positive for the year at 4.50%. Europe, Asia, and the Far East was up 1.65 for a year-to-date of 4.72. And as I said, the bond index even was up last week 1.17%. I'm talking about the U.S. aggregate bond index. The 7 to 9 year maturity area where most people have their bond holdings was up last week 1.17%, still down for the year though at just over 2%. Municipal bonds are also down for the year 1.02, up slightly last week at 0.68%. Obviously no changes in the Fed funds rate. We're going to talk more about that in a minute. That should have been a part of the headlines, by the way. The Federal Reserve met last week, and they kept rates at 5.25 to 5.5 as expected, but did reduce the amount of treasuries rolling off the balance sheet from 60 billion to 25 billion beginning in June. That means that they're going to stop issuing as many treasury bonds. And that's a good way to help also cool the economy. In the press conference following the announcement, Chairman Powell noted that rates are likely to stay at their current levels for an extended time, while also acknowledging further hikes are possible, but emphasizing hikes were unlikely given the current data, and that's one of the reasons that we saw the market turn around. I'm jumping right into the analyst report here from our analyst. They write, the Fed is in a wait-and-see scenario, acknowledging that improvement in inflation had stalled, but believing the current rate level is still sufficient to bring inflation down to their 2% target. This analyst, our analyst, says, we believe that's likely true, but the labor market has to weaken at least modestly to renew the inflation downtrend. I'm not as convinced that we're going to see 2% inflation anytime soon. I think that we're going to be hovering in the 3 to 3.5% inflation range. I hope I'm completely wrong, but I think sitting here when we're talking about our year-end reviews, and if it's the last year before, or last webinar before the end of the year, I still think we're going to be at 3 to 3.5% inflation, which means we're likely not to see a rate cut before then. But that is just my humble opinion. Manufacturing index was in last week. That dropped 1.1 points, 1.1 point. New orders fell 2.3 points, while the prices for orders jumped 5.1 points. So new orders fell, prices went up. That's interesting. The analyst writes, manufacturing continues to struggle to gain momentum and appears to be relatively stagnant, neither growing nor contracting. The price component is another inflation indication that is moving in the opposite direction the Fed would like to see. Another reason I think that we're just going to be holding where we are. I don't think there's a lot of risk of even if we hold, what we really need to see is the economy dropping, right? For the Fed to consider decreasing rates. But even if we continue to hold where we have this stronger economy and this sticky inflation at 3.5%, I think that the Fed has no choice but to hold there. The labor report was in last week as well. So the labor report the U.S. added 175,000 jobs in April, below expectations, while unemployment went up a bit, 3.8 from 3.8 to 3.9. Average hourly earnings dipped to a rise of 3.9% year over year. Down, it was 4.1% in March. So investors like that number because, again, we're starting to see a soft labor market, and that is thinking that, okay, if labor markets start to soften, then maybe the Fed looks at cutting interest rates. What do we have coming up? We have jobless claims, and that's really it this week. Look at that. Okay, let's see where we are with time. We're doing well here. I like to share different analyst reports. So common reports you'll hear are BlackRock, Goldman Sachs, sometimes a company called Riverfront. We use BlackRock exchange traded funds, but it's not when I'm reading a analyst report, it's not a recommendation to do business with any of these individuals. These are just things that come into my mailbox throughout the week, and I push them into the webinar prep mailbox. And I'd like to share certain ones with you folks, especially when they have competing feelings, because I think that's kind of fun. But I like this bit from First Trust. It's a long report, as they always are, but I'm just going to share two sections with you. Brian Westbury is the chief economist for First Trust, and also Robert Stein is the deputy chief economist, and they're both listed on this article, so I'll give them credit. But it reads, if the financial markets have a religion, we think we know what it is, a deep and abiding faith in the ability of the Federal Reserve to ride to the rescue if and when the economic weather turns bad. It's hard to tell exactly where the economy is right now, but it's very unlikely to be in a recession or need a rescue yet, they say. So there's a lot of information that they use to back that up, and they talk about COVID and some of the issues coming out of COVID, but I'll just read you their summary. They rate, ultimately, if the Fed is going to be successful in inflation, it's going to need a monetary policy that's tight enough to hurt real economic growth as well. And that's what I was just talking about. We saw the the labor report come down. We see orders come down, but prices go up. But what we need to see is really some dampening in the economic growth. And that's what the Fed is trying to balance. They're trying to balance, okay, how hard do we push on these brakes with interest rates? Because we don't want to stop too hard. You hear these terms: soft landing, no landing. We don't want to crash the economy, but they want to gently apply pressure on the brakes, and they're doing that. They're just holding steady, and I think that's probably the right thing to do right now. I just think it's going to be a lot longer than people may be thinking. So let me just read that again. It's going to need a monetary policy, talking about the Fed, that's tight enough to hurt real economic growth as well. That should scare the stock market, and yet the stock market as a whole remains lofty relative to interest rates and profits. So these folks are saying we're seeing growth that in the stock market that isn't necessarily supported by what's going on in the Fed. And I will absolutely agree with that. Until this past week, I really thought that we were seeing what I've been expecting, and that's some downtrends in the market. I still think it's coming, but I will take positive returns anytime we get them. So they write, this only makes sense if investors believe the Fed will be able to react quickly to economic weakness once it kicks in without reigniting inflation. And they write, count us skeptical. So what they're saying, to sum it up, is they believe that this increase, happiness in the market where we see these market increases is because they believe that the Federal Reserve can act quickly. And if suddenly the jobs and economy start falling, and rather than we're in a slamming the brakes situation, and then they can ease the brakes and hit the gas to cut rates and manage the economy and bring that back, and enough where these short-term moves in the market. And on the downside, people are seeing that as an opportunity and jumping in because they have this feeling that the Fed's going to jump in and they're going to take care of things. Now, that's been proven certainly over the past few years, but we are running out of bullets, really. And we can't pump money into the economy, I don't think, the way we did during COVID. We kind of spent all of our capital there, not really, but it's I don't know if we can jump. If we have a significant market correction, I'd hate to see us pump trillions of dollars into the economy again. I think that would be a bad move. Okay, I hope that makes sense. Let's move on. So now we are starting the Financial 15 section of our weekly webinar. In this Financial 15 section, we're going to talk about the proposed changes to Roth conversions. So this report came out. It was at the end of March. It came out from the White House, and the report is general explanations of the administration's fiscal year 2025 revenue proposal. So revenue proposals means, and revenue equals tax. So these are significant changes to the tax code. Now this is President Biden's proposal, but that doesn't mean this is a political statement at all. There are plenty of YouTubers out there that are talking about these proposals in a political way. If you're interested in that, go find those people. I am not talking about that. I'm talking about the potential future of our tax code and what we're seeing coming out of Washington. I think this is important because we don't know what portions of these changes will be enacted. It could be all of them, it could be none of them, or some combination. What I do know is that it's important to pay attention to kind of again, I used if you're just joining us for this Financial 15 section, and let me just say, since we're on YouTube, I feel like I have to say it. If you haven't already, hit the subscribe, like, and notification buttons. But I talked about it at the beginning of our webinar, because this is at the end of our weekly webinar, which has a lot more information. I gave the analogy of a GPS, and today's GPSs, they tell us when there's traffic ahead. I am seeing these things, and we can make adjustments if we need to, if there's traffic ahead, or we can just decide to sit in the traffic. I see these reports and these things coming out of Washington as traffic ahead and things we should be paying attention to. So even though these changes and proposed changes may not be enacted now, I think it's likely, and they may all go through, by the way, I don't know. I actually was thinking about this over the weekend, and I thought, boy, I'd love to see what the Tax Cuts and Jobs Act looked like and the original proposal for that. And I'm sure I could pull it up online, but I just didn't have an opportunity. And how many rules and changes were enacted from that. But let's go through it. Again, the idea is, even though whether these pass or not, we should be paying attention to them because this is the future of our tax code, and frankly, these changes have to happen from a fiscal responsibility point of view. Now, I hope they don't happen as proposed from a planner point of view, because it's going to affect the type of planning we can do for folks. And I want more time to help more people become tax efficient. Okay, so the first thing is, what you have to know is this general explanation of the administration's fiscal proposals. Let me just jump over. I've got it here, and I'll blow it up for you a little bit. But you can Google it, or you can capture this website and go to that. So it was March 11th it came out, and it comes from the Department of the Treasury. And it's a 256-page document, but we're going to be focusing on, I don't know how many pages this is, but this is the section that modifies rules relating to retirement plans. So I have lots of notes and highlights and things like that in here, but there's, and we'll go through what I think are the most impactful sections to you folks over the next week or so. But this week we're going to be focusing on limits of rollovers and conversions to designated Roth retirement accounts or to Roth IRAs. So this is, I explained to you that this is the title of the report. You can go and find it yourself. It's like I said, it's 256 pages. We're going to be focusing on this section, modifying rules that relating to retirement plans, that starts on page 86. So it's just like, this is a PDF document, so don't let it confuse you. And when I pull this up, if I'm looking at page 91 and 92, that's actually 99, I think it was, and 100 of the PDF doc if you're going through and you're a little bit confused. But what you can do, I actually don't have the table of contents here, but you can go through the table of contents. And if you don't know this, you can click on the section that you want, and it'll take you right to it. So let's go and look at the we're going to start here on page 91, because I want to first share with you the definition of a high income taxpayer. So what this definition is, because we're going to talk about high income taxpayers. So a taxpayer, read it with me here, right here, starting here. A taxpayer is considered a high income taxpayer if, for the taxable year, the taxpayer's modified adjusted gross income, and we've talked about that a lot on this webinar. What is modified adjusted gross income? What it affects? How it's calculated. It can be a little different depending on what's happening with it. But this writes, a taxpayer is considered a high income taxpayer if the taxable year, if for the taxable year, the taxpayer's modified adjusted gross income is over $450,000 for a married filing joint couple, or is filing as a surviving spouse, over $425,000 if the taxpayer is a head of household, or over $400,000 in other cases. So you can think of that as a single filer. Now, from a planning perspective, I have to remind everybody that if you're married going into retirement, it's very, very likely that one of you is going to pass before the other. So you go from filing as a married and filing jointly for most people to a single filer. So don't think about, well, I'm married, this doesn't apply to me, because it could apply to you at any time. We don't know when the other person is going to no longer be here. So I don't mean to be glib about that, but that is a reality that most people just aren't thinking about, because there's a lot of things that go on when your spouse dies, but and a lot of things that you have to deal with. But one of the things most people aren't thinking about is, well, my tax filing status and what that means to my financial planning. And that, of course, is important. You have to take care of everything else you have to take care of, but we have to be aware of these things. So that's the definition of the high income taxpayer. Now let's go to page 92. This is this limit rollovers and conversions to designated Roth retirement accounts or Roth IRAs. So let's read this together. The provision would prohibit a rollover to a Roth IRA of an amount distributed from an account in an employer-sponsored eligible retirement plan that is not already, you can read that as, designated Roth account, or of an amount distributed from an IRA other than a Roth IRA for a high-income taxpayer. So now back to anybody, those numbers I just gave you, $400,000 for a single filer, $425,000 of modified adjusted gross income for a head of household, and $450,000 of modified adjusted gross income for a married couple filing jointly. That's the definition of a high-income taxpayer. The provision, we're right here now. The provision would also prohibit rollovers or transfers of amounts that are not held within a designated Roth account into a designated Roth account for high-income taxpayers. So read that as Roth conversions. So either rollovers, prohibit a rollover to a Roth IRA of an amount distributed from an account in an employer-sponsored eligible retirement plan. So that's 401ks, 403bs, simple plans, set plan. Think about all those employer-sponsored retirement plans. So you can't do that. You can't take it from a traditional to a Roth if you're over those high-income thresholds. And the provision would also prohibit rollovers or transfers of amounts that are not held. That are not held within a designated Roth account into a designated Roth account for high-income taxpayers. So that is traditional IRA to Roth IRA. Really clear. High-income taxpayers will be defined in the same manner as above. I just shared that with you. This provision would be effective for taxable years beginning after December 31st, 2024. So if these proposals are enacted today, and if you have a modified adjusted gross income higher than $450,000, if you're a married filer, this may be your last year for Roth conversions. That's why it's really, really important to be talking about this. We'll go on to read this. The proposal also would prohibit a rollover from a distribution from a tax-favored retirement arrangement into a Roth IRA unless the distribution was from a designated Roth account within an employer-sponsored retirement plan or was from another Roth IRA. If any part of the distribution includes a distribution of after-tax contributions. So let's just continue that. Similarly, the proposal would prohibit a rollover of distribution from a tax-favored retirement arrangement into a designated Roth account if any part of the distribution includes a distribution of after-tax contributions, unless the distribution was from a designated Roth account. All right, so I'm reading ahead a little bit. We're going to address this in a later discussion, but let's go back and focus on this here. So I want to be clear about this. There is precedent for this. We've had this before where there were income limitations for Roth conversions. That was done away with, 2011, 2012, I'm going to say. Maybe a little later. But maybe somebody can fact check me on that. But we want, here's where I have concerns. First of all, this $400,000 to $450,000 is modified adjusted gross income is kind of the magic number. We know mathematically that doesn't work. Again, it's not a political statement, but as I'm thinking through this, the top of the 24% bracket right now for married filing joint folks is just about $380,000. So we're not too far away with some inflation adjustments when we take people up to the top of that tax bracket. And we don't know if there's going to be an inflation component, right? So that's question number one. Question number one really is, does it pass, right? Does it pass? So there are many questions about that because, first of all, there's an election coming up. Again, this is not a political discussion, but there's an election coming up, obviously. If President Biden wins the presidency and Democrats have control of the House and Senate, who knows? It might all pass as it sits. I don't know if there's a different party in Congress and a different party in the White House. Maybe it doesn't. I don't know. But so that's really the first question. Number two is, are there exceptions to the modified adjusted gross income for Roth conversions? If there are exceptions to that modified adjusted gross income calculation for Roth contributions now. So if your modified adjusted gross income is above certain thresholds by just general earnings and interest and things like that, then you can't make, or the amount that you can contribute to to a Roth IRA is reduced, with the exception of Roth conversions. So if you do $100,000 in conversions and that puts you over the modified adjusted gross income thresholds for Roth contributions, then that $100,000 doesn't count. You can still do a Roth contribution. I've shared with you that is a common error that CPAs and individuals make, where they discount the ability to make Roth contributions because whatever reason they don't know about that exception. So will there be an exception to modified adjusted gross income calculation for Roth conversions? So what I mean by that is if you have $100,000 in general income, and then you do a $380,000, I'm just throwing a number out there, I'm going to go over 450, so $360,000 Roth conversion, that takes you over the modified adjusted gross income amount. They may allow for that conversion amount to be set aside for that calculation, they being the folks who write these laws, and that's Congress. So are there exceptions? Does it pass? Are there exceptions? And then 3, and this is the most important, I think, is what is the future? So whether these pass now, whether they pass as they are, some modifications, whether there's exceptions or where we are, these are the things that are being discussed. There are quite a few other things in this proposal that I'm trying really hard not to get into right now. But this is one of them. But we want to just focus on this area here, and that is the big change, potentially big change, in who can do Roth conversions. And again, I want you to pay attention. You might say, well, geez, I don't earn anywhere near $450,000 or $400,000. But if the tax code includes your Roth conversions in that modified adjusted gross income, you can easily be over that number, even if you're maintaining your income up to the top of the 24% bracket, because those income amounts adjust every year for inflation. Hopefully we keep the 24% bracket the way it is. Hopefully the income levels stay where they are for now. I think there's a good chance that they'll be very, very similar to what they are. But this is an important potential change and something that we should all be paying attention to. Okay. We're going to talk more about backdoor Roth conversions or backdoor Roth contributions. Boy, I did it too. I've shared this with you, and I had a discussion with Sarah Brenner, the woman who wrote our first Slott Report at the beginning of the webinar. I said, Sarah, what's going on where suddenly backdoor Roth contributions are being called backdoor Roth conversions? Is there something I missed? Is suddenly some kind of clarification that came from a court ruling or something like that? And she said, I don't know. Just people suddenly started calling it that, and so you'll see it. She said it doesn't really matter because there's really not a technical term for the backdoor Roth contribution, but it really is a backdoor Roth contribution. It is not a backdoor Roth conversion, but this proposal will also eliminate that. We'll talk more about that in another webinar. But let's just recap here. Let me find my checklist, make sure that I covered everything we need to talk about today. Let me just go back here. So we talked about the general explanations of the administration's fiscal year 2025 revenue proposals. We focused on the section that starts on page 86, modify rules relating to retirement plans. We focused even more on page 91, which is definition of high income taxpayer. We talked about $400,000 for a single filer and modified adjusted gross income, $425,000 for head of household modified adjusted gross income, and $450,000 in modified adjusted gross income for married couple filing jointly. Then we focused on page number 92, item number 2, limit rollovers and conversions to designated Roth retirement accounts or to Roth IRAs. Very simply, that means if you make over those certain amounts without any exceptions applied, if there are going to be any exceptions, you can no longer do Roth conversions, even whether you're in your retirement plan, your company retirement plan. No Roth conversions allowed. Even if your plan allows it, and not many do, but that'll be taken away. And even in your own traditional IRA to Roth IRA, you've heard me say that this is the gift right now. The way the tax code is right now, the IRS says you can earn as much money as you like, or the tax code says you can earn as much money as you like. You can convert as much or as little as you like. You can convert $1,000, $100, or $1 million, $100 million in any given year. All you have to do is factor the tax that you want to pay on that. So that's a real gift. It allows us to choose our tax rate for now and for our lifetime. Really lock in your tax rate for your lifetime plus 10 years, because you're the folks who inherit your money, they don't have to distribute that until the end of the 10th year, after the year you pass away. So you have the opportunity to lock in tax rates, low tax rates now, for your lifetime plus 10 years. But we may see a limitation on that, and it may affect more people than you may be thinking, because unless they include an exception for Roth conversions in that modified adjusted gross income calculation, it could eventually, probably within a short few years, affect a lot of people. We have to pay attention to these. So even if these, let's say none of this passes, none of this goes through, I don't know. But we have to pay attention to these proposals, because this is what's on the minds of the folks who make the rules. We've got big storms ahead. I shared with you at the beginning of the webinar that Social Security is going to be running out of money very, very soon. We just got an updated trustees report. So within 10 years, 2033, the trust goes to zero. Medicare is shortly after that. And there's a significant reduction in benefits of these trusts go to zero, and nobody's going to accept that. Nobody's going to accept reduction in benefit for Social Security benefits or Medicare. We also have to pay interest, increasingly huge amounts of interest. We're going to pay about $870 billion in interest this year on our national debt. The national debt continues to increase. We're at just about $35 trillion as of May 7th, 2024. We'll pay $870 billion in interest this year. Soon we'll pay $1 trillion a year, and that when we hit $1 trillion a year, it's just about every nickel of revenue is coming in to pay our national debt. And we have to pay for all these other things. So we've got to pay attention to these proposals because of the future of tax rates, restrictions, and changes. I want you to keep your mind open for these changes. This is a discussion about these critical items. Don't let these things surprise you. I stood in front of classes several years ago and I said, we have this thing right now called a stretch IRA. There's no formal name for a stretch IRA, but it's something that you can, when you inherit an IRA, you can use your own life expectancy and stretch that out over your lifetime. It's a really great tool that we can use. And I used to say, but it's going to go away sometime. It's going to go away sometime because the federal government doesn't want you to delay that tax for your lifetime. By the way, it could have been a couple different lifetimes. Excuse me. And I used to caution people, but this will go away. Folks, I'm doing the same thing here. So listen loud and clear. We should be paying attention to these proposed changes because there are things that are going to go away. And it could certainly be the ability to do a Roth conversion no matter how much income you earn. It could also, they could limit how much you could do in a conversion a year. I don't think that will happen because if the more conversions that are done, the more income tax the federal government receives. But they could limit the amount a person's ability to do conversions based on the income limitations. Now, listen, I don't agree with that because that puts I think that puts a damper on the amount of tax revenue that folks could the government will receive if you're limiting the amount. Excuse me. How can I say this? If you're restricting the folks who can do Roth conversions, you're restricting or minimizing the amount of tax that's coming in to the government. So in the short term, certainly. But we know that the folks in Washington are not long-term thinkers, right? They think more so now. Okay, I think we've covered it all. So we got to pay attention to future tax rates, restriction as changes. We talked a lot about what we see today. We're going to talk more about this in the coming weeks, and that's it for today. I hope you have a great week. I hope all that information was helpful. The good news is that we still have time, right? You might say like, oh, Jesus, just gets worse and worse every year. And we are listen, that window is closing. It's closing and closing. It's getting more challenging to schedule these Roth conversions in the time that we need to schedule them, because we're arriving at the front door of the point of time that we're going to have to make change. We as a government, as a nation, are going to have to make significant financial changes, and the only source of revenue that the government really has is tax. And there's, really the vast majority of revenue comes from the middle class. So things are going to have to change. So open your mind to these changes. Take advantage of the opportunities you have now. To do things like potentially do things or look at doing things that make sense for you, Roth conversions and other tax efficient strategies. And if you have questions, you want to find out more from us, you can do so by reaching out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. You can explore more information and videos at attleborowealth.com. And if you haven't already, you can subscribe to our YouTube channel. I do these webinars just about every week. And we'll see you again next week. Enjoy it. Take care. Bye-bye.